Good afternoon, all. It is a pleasure to have all of you for today's session. Thanks for taking out time and coming. One of the reason why we looked at now it become very appropriate to look at tax angle as one of the key thing because if you look at in recent budget what government is trying to make so slowly what we are seeing that all the tax free instrument government is trying to make it taxable. So this is something which is showing early sign that we have to start looking at options which are more tax efficient because government is trying to make most of the instrument taxable. And if you look at in recently in budget, they have made MLDs taxable at per the debt funds. Then same way they have raised it for insurance plan also above 5 lakh. Their payouts are taxable. So this is something which is showing a early sign that as retirement is a main key part for anyone from a planning perspective. So looking at tax efficient option make a lot of difference because same two instrument which is giving similar return, but someone who is in higher tax bracket for them it make a lot of difference over a period of a longer time. Sanjay, can we have a poll first so that yeah, so what to be considered as the ideal corpus for immediate retirement for a 1 lakh of a monthly pension? I think the objective of this question is to understand that how planning is important because sometimes if we don't have our goalpost ready, then always we start seeing things in a different way. Yeah, so I think the if you look at yes, majority of them are able to have a right number. Like 2 crore would be the immediate thing, but 18% have shown like 1 crore, 28% 5 crore, 12% 10 crore, which means it shows that sometimes we are not able to have our planning in a proper way, and we're not able to have a clarity in terms of what is the corpus we require. So I think the first step for any planning is that to have your goals defined because that is very critical for us to before we go on the planning side. Yeah, so the agenda overall for this webinar is that how to build a regular income post-retirement perspective, how we can enhance wealth and best investment option. See, there's always a myth that post-retirement means the only option which is left over is safe investment like FD, real estate, or keeping money into fixed deposits and government schemes. But if you look at the way our inflation's number are increasing and the way our lifestyle has changed, so similarly we have to look at the options which are take care of inflation also, and plus it provide us the flexibility of the investment also. So I think in today's arena we have to look at investment options keeping three things into the mind. One is the return, that's the first thing. Secondly, the safety part, and third is from a tax angle perspective, because tax play a very major role to make sure that what is the post tax returns we get it. So I think as a retirement planning process, because that is the most critical part for us, as we told that first set your retirement goal. What is the monthly pension amount what you're looking at? And the best example for the same is what is your current household expense. So I think typically post retirement, same thing will continue by and large. Only thing what we have seen that component get changed. So for example, somebody may have EMI as one of the major expense. Post retirement, maybe travel and medicals can take the larger thing. So people normally have a view that their expense will come down post retirement. That is not a fact. Actually, their expense will remain in the same way because uh, other expense will take the bigger part. After looking at setting the retirement goal, then looking at the current financial position, overall perspective that what are the how they have their liquidity. Because sometimes what we have seen that people do a mistakes that they hold major part of their money into illiquid investments like real estate. What is going to impact that? Because post retirement they need a liquidity more. So I think that is the most important part, that the liquid and non-liquid portfolio needs to be balanced out, because after a time you will not be able to manage liquid investments at a larger extent, and it will not take care of your goals, because typically ROI on the real estate side will be on the lower end. Then third is identifying the retirement income source. So typically retirement income source post retirement, somebody may have a rental income, somebody may have interest income, someone have a capital gain income from different investments. So once we have a clarity, then based on the risk and or health situation, we invest into the retirement asset. So I think first we go through these three process, which help us to take a call what should be the ideal way of our investing. And then retirement corpus needs to be looked at on a very regular basis, because that will be a larger part of our corpus. So we cannot invest the way we are investing early retirement. So that's the reason always say that before retirement investing and after retirement, it's completely different, because your goals will change and your asset allocation needs to be looked at more carefully, because that is the only funds which will be left over for whole life. And the way the life expectancy is increasing, which means we need the funds for a longer period of a time, then we have to look at the regular monitoring. So in this session, I will look at to take you what are the different options, and then we will focus on the two of the options which are can give the tax-free income, and which could be a much more appropriate for major part of the people who are looking at retirement in next 5 to 10 year perspective, or even the immediate retirement. So first option come bonds, because bonds are the one which have a fixed return, like tax-free bonds, perpetual bonds. So tax-free bond where you don't need to pay any tax on the interest what you get. So currently, if you look at most of the tax-free bonds are giving like a 5.5% type of interest, but today they are not available in the primary market. If somebody has to buy, he has to buy through a secondary market. Then perpetual bond, corporate bonds, and last is the sovereign gold bond fund. So wherein the returns are linked with the gold price, plus you get 2.5% as an annual interest. The second way, which is the most popular in terms of most of the client perspective, mutual fund route, where they invest into a debt mutual funds, bond, Bharat bond ETF, FMPs, or capital protection funds. Then third come retail, for example, all PPF, PF, VPF, then senior citizen saving scheme, or keeping money into a post deposits and other thing. And the last option come, for example, the all those pension plans, NPS, guaranteed payout, and endowment plans. So in this session, I would like to keep the things which are going to make a difference. So because majority of the investment option today, if you look at, there is a tax angle is there. So today, if someone is investing in a debt mutual funds, after 3 years, there's a 20% with indexation, there's a tax liability. Or if someone is keeping money into the FD, he has to pay the tax. So today, if you look at what are the options where you get a tax-free money. So if I look at predominantly, one is somebody is investing into the PPF. There is a 1.5 lakh of saving what somebody can do it, and that is something which will be tax free when they get a payout amount. That's the first thing. The next part come the pension plans, and third come if we do it equity funds up to 1 lakh of payout, which is tax free. So these are the three major one which is our tax free options we have today. The next part, if you look at what is the way how your debt to equity allocation should move post retirement, because that is something which is very critical. Your portfolio needs to be relooked at over a period of a time as we needs the fund. Your overall equity component will come down and your debt component will increase. But normally people have a myth that post retirement it will be a debt portfolio. So you nobody can survive only having the debt portfolio except somebody have built a large corpus. So somebody has to look at that. If we are looking at from a long term perspective, he needs to have a balanced mix of debt and equity, but with appropriate changes based on corpus requirement. What is the ideal age and how the planning needs to be looked at? So typically based on the age bracket and the risk profile, these are the different debt to equity allocation of what we normally suggest, which should be. So you can see that at early age we can go aggressively on the equity side, and then we can go lower on the equity allocation. But in this thing, the another part which comes, what is the overall corpus you have built up? So someone who have higher corpus, they may go aggressive on the equity side. So sometimes all these ratios and other things are not useful if we have not looked at the overall picture in terms of what is the your overall corpus, what you have, how we do the overall customized retirement planning, because that is the most important part, because everybody have a different needs and everybody have a different risk profile. So based on their cash flow requirement, we have to look at, first thing to look at, have a proper health cover, because post retirement the first foremost thing somebody needs to look at from a health angle. So health thing is something which we have to look at. Then second part come, is it your liabilities are taken care with the life cover, because there may be some liability which is continue. So if we have appropriate life cover, that needs to be looked at. Third is creating an emergency fund, because that is something for certain needs which we don't know which can arise. So typically what we suggest that at least 6 months of your monthly expense you keep it as an emergency fund, which can be used any point of time. Plus have a one health perspective, also one contingency fund which is apart from your emergency fund, from a post retirement perspective. So typically that could be normally 10 times of or 1 year of expense equivalent. So it could be a 40 to 50 lakh as a medical perspective, one contingency fund which we can have it. The most important part is that how we build a regular income. So that's what something which we look at, and we look at tax angle at a first level. So what are the different options we have on a tax saving perspective? PPF is the one option which we discussed, but in PPF we have a limitation. You cannot go beyond 1.5 lakh. But secondly, we have an NPS. Then we have a senior citizen saving schemes, then deposits and mutual fund, pension plans, and life and health insurance. So I'll take you through all the steps, but I'll focus mainly on to two major investment option which we think can make a lot of sense from a today's time perspective. And these are the detailed options into a different segments. What we have: equity hybrid mutual funds, ETFs. Then we have a tax-free fixed deposit, post office, NSC, PPF, and then we have a debt funds, FMPs, tax-free bond, NCD, deep discount, and then retirement income plan. But most of them, they have a issue that they get a lump sum money or they are taxable. Then from an NRI perspective, the interest earned on the NRI deposits, it's a tax. They have tax exemption. Then apart from that, whatever the investment they are doing it from a long-term perspective, they can get the exemptions. So first thing I look at, for most of the people who are going to retire in next 5 to 10 year perspective, the main thing is that, see, for example, they may getting money lump sum from PF, but it will come as a lump sum. So one thing is that how we can build long-term regular income, because two things we have to look at. One is, if you look at today, we are at a peak of interest rates, and if you look at historically and globally also, if any country is going to be on a developed side, typically interest rates will be in a 2 to 3%. So if I look at from here, in next 10 to 20 years, we will be into a 3 to 4% interest rate scenario. So when interest rates are at a peak, that would be the ideal time for someone to lock the money at a higher interest rates, especially from a retirement perspective. That is the first thing. Secondly, we have to look at the tax aspect, because post of 31st March, all the pension plans above 5 lakh will be taxable. So someone who is looking at to build larger corpus uh, from a regular income perspective, he needs to look at tax angle very critically. And the third foremost part is that any investment which we are doing it should take care of our objective. If you look at the what has happened with SVW Bank, recently the US startup bank, this is a typical issue where there is a mismatch between the need and the investments. They have invested into the papers which are money is going to come of a 10-year bonds, and they have taken a depositor's money which is a short term money. So I think for any investments, if we are looking at to do investment, it should be based on our requirement. So I'll take a first case study thing, that how somebody can build a tax-free retirement income. So like for example, somebody is looking at to have for 30 years regular income tax-free. If he is investing, for example, 10 lakh for 10 years, he going to get 12 lakh around for next 30 years, that is tax-free. Over and above that, whatever the investment he has done, that also he'll get it back with additional 10%. So typically, if you look at on someone doing 1 crore of investments, he end up getting almost 4.5 times of investment. But the most important part, I think, more than return. See, you are getting 7% around IRR, 6.8, but it is not something very great if I look at, if I don't look at the tax angle. Because if I look at pre-tax, same thing could be 11%. And the most important part, it is taking care of your cash flow for next 30 years. So sometimes people may think that I am investing for a very long period of a time, but he needs to look at the other part also, that he's going to have cash flow clarity for next 25 to 30 years, which is sometimes not possible in any other instrument, because someone investing in FD and other thing. So it's an alternative option to real estate. So earlier days, people used to invest in real estate to get a rental income post retirement perspective. So but that is not tax efficient and tough to manage. So it's an alternative way of the same, how you can have much more managed way and tax efficient option. So these are the two scenario we have given: somebody investing for 6 year and 10 year, how we can get if somebody is doing 6 years investment, he can get a 5 lakh of annual income which is guaranteed tax free. Somebody doing 10 lakh for 10 years, he can get 12 lakh of regular income for 30 years. So this is the one of the options which we can look at. The next options in the same we have, where he can get it the regular income for the lifetime also. So that could be a alternative way based on his requirement. It could be, if you look at the tax angle, how it's going to differentiate. So the if you look at the, if somebody have a 2 crore of a gain, 80 lakh would be end up going on the tax. So I think that is one of the reason why we have looked at this thing very critically now, that from 1st of April, tax is going to take away the major part of the gain, and then it may not become ideal for someone who is looking at larger corpus build up through fixed income. And that could be another way. It can be used as a generation plan, where somebody wants to plan for his family level also. It can get added to get regular income for the family, and plus taking care of the next generation also. The next plan which we will be looking at, how we can do it using mutual fund route. So this is the first route we what we looked at, using it pension plans. The second thing is using the dynamic funds. So dynamic funds, how it works? Typically, they invest based on the market scenario. So within a fund, it take care the debt to equity allocation. Many people are not aware that there are funds which are available which take care debt to equity allocation based on the market scenario. And to give an example, how typically it works. The reason why it become very ideal. So you can see that equity remain always volatile. You can see last 42 years how index has moved. So there are years where we have seen the very sharp drawdown and market has corrected very significantly. So there are a lot of key events which always be remain. So in those point of a time, these balance advantage fund add lot of value because what they do is they will have a mix of large and multi cap on the mid caps on the stock side. They follow the asset allocation, so they go 30 to 80% net equity allocation, and they do hedging also within a portfolio. So this is something which could be a very ideal way for someone who is looking at to build portfolio from a retirement perspective. And you can see that how they change their portfolio level exposure. So uh, this is like from example Feb 2012 to 22. So there are times there when 80% equity exposure they have come down to almost like 25 to 30%. So based on the market scenario, if you can look at how the overall portfolio allocation changed, that take away the emotional aspect and the major issue of capital gain and taking of all sort of effort, especially from a retirement perspective. And this is how the overall equity exposure moves. And you can see that what is the average equity exposure. So typically they will have 36% equity exposure on an average. If I look at in a current scenario, but you will be surprised to know that the returns what they are able to generate, especially when markets are flat. So balance advantage funds, if you look at, we have taken one particular fund which is best in the category, and we have shown the performance of the same. So when markets are flat, it able to give you 8 to 9% type of a return. So this is something which add value, especially for clients who are looking at inflation plus type of a return. So these are the different times when index has not moved and how the fund has able to generate. So you can look at when 3rd June 2019 to 25th Feb 2020, 21 to 22 markets are flat, and this is how the fund has generated. And this is the financial year wise comparison that how as a fund has delivered. So see, this is the one thing which I would like to highlight. Sometimes we always think that taking a risk will give you higher return, but that is not necessary always. You have to do play a smart on the allocation. That is something can helpful for to give a better return. So if I look at from 2010 to till date, if I look at the index return, it has been around 11.2% on a CAGR level. Same time, the balance advantage fund is able to give you 11.7%. And that too with having such a low equity exposure. So if I look at from a risk side, we are taking a very low risk. But if I look at return side, we are able to capture equivalent to index. The reason why we are able to do because we limits the downside in these funds. So you can see whenever there's a large downside, like in 2012, 11, 12, markets was down 8%. It was 0.5.8 plus. 15, 16, market was 8.9% down. It was positive. Then 19, 20, 25%, 13%. So that is something which add value to a higher return. So these type of fund may not do great when there is a euphoria in the market and market do one way up. So for example, 2020 to 21 where index had a one way rally of 79% and it did 49%. So but it will protect your downside. So in a retirement time, that is the one of the most important part that we should not look at the upside only as your criteria. We have to look at downside. Capital preservation is more important than the appreciation, because many times people do a mistake that they invest looking at the past performance of the funds and they end up losing the capital because past is not going to be the future. So and especially if your 100 has become 50 to 50 to 100, you have to almost do 100% return. It's not like 50%. So that is the most important part. If your funds are able to protect your downside, your upside will automatically come. So this is the fund which we are talking about. If you look at from all the angle, if you look at the average returns in 3, 5, and 7 years, it is 12%. So 12% is a good enough return for someone who is looking at retirement corpus. And if you look at the volatility, it is lower than the index any point of time. And if you look at most of the times, they are able to give 88%, if I look at from a 5 to 7 year perspective, they have given more than 10% return. So this is the one of the another option which we can use it on SWP way. So how it should work for retirement portfolio for regular income. So what we typically do it, invest into this fund and opt for SWP. There's another myth normally people have that invest into a dividend plans, thinking that dividend is something which will take care of their regular income. But in today's time, if you look at dividend is taxable and it is not tax efficient. So instead of doing the dividend, we normally suggest that we should use SWP option, and typically always that invest for 1 year and then second year onwards start using the SWP option. And how it can become a tax free, because currently all the BAF fund, they are have equity taxation. So up to 1 lakh of equity capital gain is tax free every year. So at least someone who is looking at 8 to 9% type of a cash flow on 20 lakh of income, he will be able to have it on a large extent. So up to 1 lakh of gain every year could be a tax free. So this is the another thing which we can look at. And even above 1 lakh of a gain, it is only 10%, which is least compared to any other investment option. And secondly, returns are better than any other option, because here you can expect 12% type of a return. Something, if you look at the other options, which are the low risk, you may not be able to see similar type of option. So in a current scenario, overview is that doing a combination approach where we look at guaranteed pension plan to provide the regular cash flow and stability. Dynamic fund can add growth, plus it can provide the flexibility. And how it add value, because if you look at, there is no TDS. Up to 1 lakh of a gain is the tax free, and in case there is some units we are exiting at a loss, it can be adjusted against the profits what we had over a period of a time. And this is the example what we have given, that how somebody can look at, for example, somebody invested 10 lakh and he has taken monthly 5,000 rupees SWP. So he can have a 60,000 of cash flow, which is completely tax free on up to 1 lakh of a gain. So ideally, it had a lot of value as a part of allocation, because this is something which is not being used very effectively from a retirement perspective. So normally people invest into all these instruments which are lower yielding one and non and taxable. So this is more efficient way of managing money. So just to summarize, its benefit out of volatility: it buy at low, sell at high. It generate good potential return when it has gone through the full market cycle. So these funds will work better if you invest like more than 5 to 10 year perspective, because you will see that up and down both from a market perspective. So how the overall things work? So I think I've taken through the two options, which are could be a lot of add value in terms of retirement perspective. Invest as per different risk class per risk level, and it should be diversified across. And what we can look at have planning, succession will, and other things, because post retirement these are things become very critical. The investment is a one part, but the another part is come that how we do the overall planning, which includes nomination, will, succession, and how we manage this investment, especially taking at everything on an overall perspective. I think that's all. So normally we suggest our parents are not your emergency fund, your children will not be your retirement fund. I think create your own wealth. This is something which is going to helpful for us, and this is the best way to build, do a combination approach and invest into a multiple different options. And at this point of time, we are suggesting that invest options based on our requirement perspective, because today we are going through a phase where earlier time we used to tell that till the time we are earning we have to pay the tax, but the way things are changing, till the time we are living we have to pay the tax. So tax is going to take away major part of our gain, so we have to plan very smartly. The other way, normally what we suggest that how we can do a better tax optimization. One way it could be creating HUF, doing investments in the family level. So there are different ways also which can be built up to optimize on the overall capital gain perspective. But the most important part is that we have to have based on our requirement or proper asset allocation, and we should know what we require, because what we have seen most of the time, people are not aware that how inflation will take away their portfolios. So to give example, somebody need 1 lakh per month. So typically if you look at same thing in 10 years it will become 2 lakh, and 20 years it will become 4 lakh. So if you look at, it is not two times, it is like a four times. So 20 years you need four times more money. So the power of compounding is something which is very critical, and to understand that how it impact the overall portfolio, and that is something which we always suggest. And how we do the investment into different options which are more tax efficient and we take care of the cash flow, that is more critical. I think that's all from my side. I would like to take more time to understand the individual questions, and we can have a Q&A.
Thank you so much, sir, for sharing valuable insights. There are a lot more questions. I will be reading it out one by one. Also, I would like to request everyone to post your queries and questions in Q&A session. We will be taking it one by one. So the first question is, like, with insurance guarantee payouts plans become taxable post April, how much corpus premium amount we can block and lock our capital in such product?
See, overall, all view is that it should not be more than 10% of your overall net worth perspective allocation into any of these products, because see, all these are the long term investments, and it should be based on your cash flow perspective. It should not, you should not be end up impacting your liquidity. So I think the most appropriate thing is that based on your financial plan, based on your cash flow and your risk profile, decision should not be taken. So we should not do investment just thinking only one angle of a tax and end up paying higher premiums, and later stage we end up not able to manage the thing. So we always say that any investment option should not become the only allocation. It should be I think 10% of the net worth. What would be the maximum we will be looking at on a overall allocation perspective, even the total amount what we invest over a period of a time.
Uh, Thank you, sir. The next question is, are HDFC Life Sanchay Plus fixed income goods plan?
See, all the plans are good. The point is, when we are taking that point of time, which plan is giving the better IRR in the top company. So what we do it, maybe our team will reach out to you later and look at based on your age profile, which plans is giving the better IRR. That is something which we can look at. So I think there is no particular plan as such. What we are suggesting that you should look at only that. It should match your requirement, and every plan will have a different IRR based on the age bracket, based on the male female level, and the income investment amount perspective. So that's something which we can look at based on your customized requirement.
Thank you, sir. The next question is, if we have a residential plot, can we place them to obtain loan against property and reinvest in financial instruments to maximize potential? Or what other avenues are present given we have 7+ years time frame for retirement?
We don't suggest that we should look at taking loan and invest, because this is a disaster for our portfolio, especially when rate of interest is on the higher side. So we will not suggest you to venture into these type of options where you take the money on loan, because here the returns what you will get, it will not be able to take care of the rate of interest what you will be paying. So that will not be the ideal approach.
Thank you, sir. The next question is from Mr. Praveen. He's saying I'm retiring in October 23. Suggest me regular tax-free lifelong income on investment of lump sum 30 lakh.
Yeah, so I think, as I said, we have to look at adding multiple options. So two of the options which I have suggested, then plus with that, we have to add some of the funds. So what typically we suggest that retirement perspective, we have to create a three different buckets. So one bucket is like for next 3 to 5 years of funds. So that we have to keep it more on the liquid money side. The next is 5 to 10 years and 10-year plus. So something which we are investing for 3 to 5 years would be on the low risk side, not linked with the market. 5 to 10 years is a moderate risk where we can have 30 to 40% equity allocation. 10-year plus is something where we can go aggressive on equity allocation. And that's how we have to design our portfolio and look at. So I think for someone who is looking at for retirement, at least he has to do one time full exercise in terms how his portfolio needs to be divided, because once you do that exercise, then it's only then delta level you have to do the review of the same, but that will become very critical, because once you do a right allocation, things will be taken care automatically, then you don't need to plan it separately.
Thank you, sir. There is a question related to how the retirement money should be invested. So Mr. Abhinav Pandya asks how to plan with corpus of approx 3 CR in retirement.
Yeah, I think for that, what I would suggest that how much you will be requiring monthly pension, because that is going to be the deciding factor. And secondly, what are the other goals you have apart from retirement? So someone who have a 3 crore of a retirement corpus, he can ideally go on based on his cash flow level aggressively on the equity allocation. But I think the most appropriate part to look at on their cash flow and overall fund requirement, because that is something which will be helpful. Maybe post call will make and have a one-to-one call and understand the requirement, and then we will be able to give you the right advice.
So the next question is there any retirement plan for regular income? Which one is this?
Yeah, so that's why I mean there are multiple retirement plans, but point is which is suitable for you. It depends on your age when you need the funds. So I think what we do, we will reach out to you personally and understand your thing, and then we will suggest what would be the ideal option.
Thank you, sir. The next question is it better to take one-time payout or deferred payout in fixed return plans?
It is better to take one-time payout or different payouts. See, I think better look at payouts at different point of a time, because how you require the funds, because that is the most important part. So many times people invest into the annuities where they get lifetime regular pension, but later part they realize that they may need some liquidity of from that corpus, and secondly that annuity is taxable. So I think the most important part for someone to understand is that what is their requirement, and that is something should be the deciding factor of any investment option. So we should not just go by looking at safety and the return. We have to look at that what is the flexibility we are looking at, and secondly how it can take care in a different scenarios perspective.
Thank you, sir. PM, the next question is what is the ideal percentage of expected pension one can plan by these insurance-linked tax-free retirement option? Also, it is worth for people less than 40 years, considering the cash flow is not required for at least another 15 years. Because if the cash flow starts early, we again have to invest same when one is far from retirement.
Yeah, so I think that's a very valid question, but there are two things which we have to look at in that. One is, will you able to get similar option later based on where we are from an interest rate cycle? So that's a one thing which you have to look at. So even if you are investing it, ideally the cash flow should start coming when you are going to retire. So in case if it's going to come early, maybe which is maybe 2 to 3 years, then it is fine. But if there is a larger gap, yes, then we have those options may not become ideal. And secondly, this is something is a part of the debt allocation. So even somebody who is in young in age, as per the asset allocation, there will be a part of debt allocation. It's a similar to what we kept it either in the PF or PPF, NPS, or any of the retail purpose. So it's a part of the debt allocation. So we have to look at what is the debt allocation which is required based on your profile. And if it is within that, then only it makes sense. So we always say that we always should look at that what is your portfolio mix in equity and debt. Especially what we have seen that when markets are gone through up and down cycle. So sometimes doing a regular profit booking and reinvesting into the options which is as a part of debt allocation add lot of value, because indirectly you are safeguarding your portfolio risk. So I think that is the most important part, that if it suits our requirement and it is within the data location, what is required based on the current thing. So for example, someone who is at 30 to 40 years, where typically 70 to 80% equity and 20 to 30% debt. So if it's a part of 20 to 30% of a debt allocation, then only it makes sense.
Thank you, sir. We have the next question is how Wellness Advantage funds are tax efficient? Please explain.
Yeah, see, balance advantage funds are tax efficient. First thing, because up to 1 lakh of long term equity capital gain is tax free. So at least that is the one part. Second thing, even above 1 lakh of a gain, you are paying only 10% long term capital gain. So if you look at compared to any other options, that is much more better. The third most important part, if you look at, it can give returns which is better than inflation. If I look at from a long term perspective, so this is the option which is it's in a hybrid in the nature with low risk, and it only thing here you have to give a time, so you cannot expect that it will start doing wonders in first year itself. So if you look at from a 5 year power cycle, it will be able to give you 10 to 12% type of a return with the regular income flow with good stability. And the most important part, the capital gain income, so that also will be taken care at a fund level. So sometimes people don't realize that how it is important, because every year you end up paying capital gain tax. And secondly, the emotional aspect that you always have, that you should book a profit and all those things. So sometimes that thing also take care, because at the fund level it do the changes, so you don't need to get involved and you don't do a wrong decision. So if you look at historically also, we always say that there's a difference between a market return and the investor return. Market may be given 12 to 15% return, but if you look at most of the portfolios of individual investors, they may have a 10 to 12%. They will have a lower return. The reason is that the emotional part come into the picture when they see a larger volatility in the market. They take a wrong calls, and that is something which impact their portfolio returns. So that is the reason we suggest that we should start looking at the option which take away the emotional part, and as a fund it take care taking care of that part.
Thank you, sir. The next question is related to dividend income. How are the dividend income likely to grow in future? Can I assume that dividend income grows at 10% annually?
I think dividend is not going to fulfill the requirement because it is a taxable. Ideally, what we can see is that dividend income we can expect some 5 to 7% type of a gain, not beyond that, because dividend is subject to the cash flow entry. So typically 2 to 2.5% is a dividend yield what we can expect. So maybe 5% growth what we can expect for dividend.
Thank you, sir. There are a few questions in chat box. Can I read it out?
Yeah.
Yeah. So the question is, what's the best source? Life insurance, mutual fund, shares, equity, if I'm looking for retirement, which is about 40 years.
See, I mean, there is nothing called a best or worst. It's always a combination approach based on your portfolio. So I think ideally someone who at a 40 we suggest that have a higher of equity allocation. Do it through a, instead of doing on directly doing on the stocks, do it through mutual funds or through PMSs, which is much more better options. And uh, have a good life cover and health cover, because that is the base thing which is required even somebody is doing any sort of investment.
Thank you, sir. The next question is NPS good for regular annuity income post-retirement?
See, NPS, normally we don't suggest that we should go ideally higher on this. See, NPS is a good option if I look at to build a corpus, because they are the lowest on the expense ratio side. So you can see a good growth in the NPS portfolio. So typically we suggest that take the lower amount of, but the problem in the NPS is that the annuity what you are going to get, the 40% of the corpus which goes for the annuity, that is the annuity rate will be decided when you retire. So you imagine somebody is going to retire in next 20 years. If that time if annuity rate is 4%, so which means the whole corpus, he built a good corpus through NPS, but he is getting hardly 4% on that. Secondly, the pension what he's going to get, it's a taxable. And the third most important part, he cannot take out that balance 40% of the money. So that is something where we are not comfortable to take NPS as a major part of portfolio thing. It should be somebody can do 50 to 1,000 to 1 lakh contribution, but it should not be a very high allocation from a portfolio perspective.
Thank you, sir. The next question is, I have 17 years to retirement. Please suggest good pension plan.
Yeah, so I think we can look at there are multiple options for someone who is going to retire in next 10 to 20-year perspective, because for them that is this is the ideal time to plan. So maybe we will reach out separately on the same.
Thank you, sir. The next question is from Kunal. I'm 37. I'm expecting 12 lakh for a year to run my household expenses. If I invest in a VAF, then how can I make 11 lakh withdrawal as tax efficient, because 1 lakh profit from mutual fund is exempted?
Okay, 12 lakh for a year to run my house. Yeah, so see, tax efficient in the sense that you will be paying the tax as a lowest level compared to any other option. So the balance 11 lakh also you will be paying 10% only the tax part. So if I look at compared to any other option, you are paying there on the higher side. Secondly, the returns what you are getting it's an inflation plus. So that is where it make a difference. So I'm saying it is not will take care completely your requirement. You have to look at a combination of a multiple approach, but one part of your regular income it can provide you. So there could not be any one option which can take care of the whole thing. It has to be in a combination approach.
Thank you, sir. The next question is, I'm 61 and plan to invest the full amount of rupees 30 lakh under SCSP. My wife is 76. Can she also invest another 30 lakh in the same plan? Do you recommend this plan for the retirees?
Yeah, see, this is a good plan for retirement perspective, but one thing we have to look at into the consideration that tomorrow if you need a liquidity, so how you will be able to take care. Secondly, I think the most important part, what is your tax bracket you are. So I think liquidity and tax angle we have to look at. And third is what is the corpus is as a part of your total portfolio this. So what we suggest that, see, if it should not become your 100% of your corpus going towards these. So typically we suggest that even you are retiring, do 20 to 30% options, which is can be on the better side. So that at least it can handle it in a much more appropriate way. So I think that is the most important part someone to look at. So okay, the next question, I think someone looking real estate, what are their park money for downside protection and regular income? I think as we suggest that some options we have to look at on the government schemes, some options we have to look at on the mutual fund side, some options we have to look at on the pension plan side, So we have to look at on the combination approach, and we can create good ideal portfolio. Yeah, I think if you look at PPF, yes, it cannot take care of your whole thing, uh, because it may not have larger corpus creation, because there's a 1.5 lakh of a limit and only for 15 years. So majority of the retired people, they already exhaust this thing. Yes, someone who has not done earlier contribution, they may look at. Yeah. So someone has come up that, okay, Jeevan Umang, is it a good plan for tax-free pension? See, all these annuity plan where investing one time, please understand, these are taxable thing. So because they will not have a 10 times cover. So as per section 1010D, any pension plan, if they don't have a 10 times life cover, it is going to be taxable. So all these one-time investment option, uh, which we somebody is doing, they will be on a tax. Yeah, I think that's all from my side. I think what we'll do it, you can reach out to me directly or to our team. So maybe uh, what we'll do it, I can just uh, write my mail ID, and I can write my number. You can reach out, or you can reach out to our team for any of the questions if you have, and we also reach out specifically based on the requirement perspective. Yeah, I think the last question, what I would like to take, uh, there's another thing come up, target maturity funds and other thing. We will try to take in the next session. So my thing is that at least uh, take one or two major part of things, which is good in a current scenario perspective. In upcoming session, we look at some other options which could be take look at as a third and fourth option. So today we have looked at which are the two best options in current scenario for someone is looking at, and as we go forward in next retirement session thing, we'll look at the other more options which could be ideal, but they may not be better than this, but it could be a part of the overall asset allocation perspective, including target maturity funds and other thing. Because the issue in target maturity funds is that the reinvestment risk, because you may not need the whole thing and you have to plan it very effectively. So it may not ideal for everyone, but yes, certain part of segment can manage it better.